Hello, and welcome to the Freddie Mac Connect Staying Ahead of the Ever-Evolving Insurance Market session. All lines are in listen-only mode. This session is being recorded and will be available on demand after the conference. If you have any questions, please use the Q&A icon at the bottom of your screen. If you have any technical issues, also use the Q&A box and someone will assist you. Lastly, using the handouts icon, you will find links to the speaker bios and the presentation deck. With that, I will turn it over to Megan Gale, Director of Collateral Risk Policy with Freddie Mac. Megan, the floor is yours.
Thank you so much. I want to extend a warm welcome to all of those who have joined us today to discuss this very important and timely topic. For many of you, it may only be recently that the property insurance market has jumped up on your radar, but it has been a tumultuous few years as some major insurance markets struggle to strike that balance between premiums that homeowners can pay and premiums that provide enough capital to fulfill their promise to pay. We at Freddie Mac believe that insurance affordability and availability are an important component in supporting sustainable home ownership and making home possible. I'm Megan Gale, our Director of Insurance Policy, and I'm joined here today by Brian Saltmarsh, our Insurance Policy Business Lead. We're going to have a bit of a fireside chat and discuss some of the pressing questions about staying ahead of this rapidly evolving market. Hello, Brian, and thank you for joining me.
Thanks, Megan. I appreciate it. As you noted, my name is Brian Saltmarsh, and I'm Freddie Mac's single-family insurance policy business lead. We appreciate you all being here today. I'm going to get into some of the challenges in the insurance market, and we hope that you find it valuable. I guess we'll just start by jumping in. If you have not if in your daily job, you're not regularly working with insurance, you've probably still heard about it in the news recently, which brings me to my first question. So Megan, in light of some of the recent media attention that insurance is been getting, what can you share as far as the overall state of the insurance market and premium trends and where they are going?
Well, Brian, it's no secret that premiums are rising. There are large-scale state and industry factors that have driven up premiums across the nation, but how much, where, and why are different. Insurance is regulated on a state level, and this is so regulators can respond to their state's individual needs and challenges. This makes sense because the protection needed for a homeowner in Florida looks very different than the one in California. This also means that states have very unique markets, and we're seeing that a lot today. So increased weather events play a large role, especially in states like Florida, Louisiana, and through the Midwest, but it's also a culmination of other factors leading to premium increases. Post-COVID inflation in labor markets, building materials, population shifts into high-risk areas, larger homes, environments of excessive litigation and fraud, all of which drive up costs and in turn premiums. Over the last 5 years, home insurers have a loss ratio of over 103% on average. In some states, that number is as high as 128% or almost 200. That's $2 for every dollar of premium brought in. It's certainly not sustainable on a long-term scale. But also premiums are driven by individual levels as well. Not all types of homes or borrowers are impacted uniformly. So for example, a homeowner with a lower credit-based insurance score may pay more than those with excellent credit, not unlike interest rates that we see on mortgages. Also, the type of occupancy matters. Landlord policies and rental homes, second homes that are not occupied regularly pose a higher chance of claim and are experiencing generally higher premium increases than primary residences. This is particularly true of state fair plans in the Gulf states where second home ownership is high, and there's political pressures to shift the cost burdens off of residents and onto out-of-state second homeowners. Lastly, Brian, property conditions can be positively or negatively impact insurance available and affordability. Newer homes and those that have been retrofitted to more resilient building codes, such as fortified roofs, are less expensive and easier to obtain coverage. And coverage availability is so important and, of course, required on all Freddie Mac loans. So, Brian, let me ask you this. What are the scenarios where a homeowner is unable to obtain regular coverage? And if so, what does that look like?
Well, there's really a couple different situations a homeowner could find themselves in, not having coverage. So let me kind of talk about each individually. So an insurance carrier might actually go insolvent. So what does that mean for the borrower who's holding that policy when that situation happens? We saw a lot of this after Hurricane Ian in the state of Florida, in which multiple carriers actually went insolvent and were not able to pay the full amount of the claims that they had issued under their policy. But each state does have an insurance guarantee fund. And it provides protection for that exact type of situation. And it guarantees that all claims honored under that policy of the insolvent carrier would actually be paid at the end of the day. So just know, if you ran into a situation like that or one of your borrowers, there is that insurance guarantee association to back up the plan and still continue to pay the claims through the remainder of that policy period. Now, the second type of situation someone might find themselves in is they can no longer actually find coverage in the private insurance market. In those cases, most states across the United States do have some form of a state fair plan. And what these are is it's really the insurance of last resort. And when insureds cannot find insurance in the regular private market, they can go to the fair plans and join and be able to obtain adequate coverage in that manner. So there's always that fallback with the state fair plans in the event private market coverage truly is not available. And then lastly, there's a situation which has been in the news a lot lately, places like California and Florida, where carriers might either be pausing new policies and continuing to write new existing policies, or simply pulling out of the market completely. Now, if it is just a market pause, just note that that's not as bad. Those carriers are going to continue honoring existing policies on their books. So there's really not going to be a change for the insured. But someone looking to purchase their property may not be able to obtain new coverage with that carrier. And then also, in the event that you do receive a cancellation notice or a borrower receives a cancellation notice, it does not always mean that there is not available coverage in the private market. That should really be, the first place that you look should be in the private market versus something like a fair plan. The fair plans typically come at a higher premium and can provide less protection on the property, cover lesser perils. So still go out and look. If you found yourself in a situation where a policy was canceled, employ the help of some type of an insurance broker, and they're going to be able to connect you with carriers that are still offering coverage in the market. And then, of course, as I referred to earlier, if still coverage could not be obtained, the fair plan is always that fallback of last resort that would be able to provide the protection. And then, so moving on to our next question, kind of in the same topic of availability, climate change has been a big topic in the news. So Megan, how is climate changing affecting the current state of the insurance market?
Well, climate change has undoubtedly led to an increase in extreme weather events and disaster losses. And the U.S. has seen just a dramatic increase in billion-dollar disaster events. And this is not just hurricanes, but also wildfires, droughts, winter storms, flooding, and severe convective storms. We don't often realize the impact of these storms because they're not in the regular news cycle like an event of a Hurricane Ian or Harvey. But 2023 has already broken records for the most billion-dollar disaster events this year. And we've hit 23 and counting. So insurers' responses are mixed and often geographically targeted. So in markets with less regulatory friction, insurance premiums are increasing more gradually to adjust to climate risk. But states like California, Florida, and Louisiana, which either limit insurers' ability to charge premiums in line with risks or have more restrictive regulations like California, insurers are forced to make some difficult decisions, as you mentioned earlier. However, we're seeing more and more insurers and reinsurance companies responding with some promising innovations. To adapt to more sophisticated risk and analysis pricing, they're investing in more advanced modeling tools and are better able to predict future loss and have to rely less on historical loss, which we know is now becoming less and less predictive. There are numerous examples of collaboration between insurance companies, state insurance departments, and other industry stakeholders like Freddie Mac. This is taking a variety of forms, from insurance commissioners requiring discounts for properties that meet certain resiliency and building code standards, states supporting grant programs enabling homeowners to upgrade their properties, and even expanding disclosures and awareness education. Additionally, many local communities are implementing initiatives to enhance resiliency, not only to make the community safer, but also more insurable. And on an individual level, homeowners are increasingly urged to be proactive. So it's important that they have an understanding of their risk and what is required to secure adequate and affordable coverage. However, even the most informed homeowner, particularly if they have been a long-term resident, may find that their local insurers are becoming more selective in the risk they're willing to take on. Standard policies in disaster-prone states are becoming less and less standard, and insurers are limiting the risk by offering larger minimum deductibles, including more coverage limitations, more coverage exclusions, and in some cases, like you mentioned earlier, Brian, completely exiting out-of-state markets. So, Brian, with this shift away from policy standardization in these certain climate disaster-prone markets, what are some key considerations that sellers and servicers in the audience might consider to be extra vigilant when underwriting or servicing loans?
That's a good question, Megan. And, I could answer it in a million ways. So I guess the best way to answer it is to stick to some of the topics that we're kind of seeing being misinterpreted on a more common basis. And I guess I would start with, when you're looking at a certificate of insurance or the declaration page, whatever the insurance agent provides to evidence the coverage, you really need to make sure you're understanding the information on those documents and what the insurance agent is actually trying to convey. One of the biggest areas of conflation we find is with how a claim will be settled and the payment will be made based off that settlement versus having an actual coverage limit. And if you're just simply looking at a standard declaration page and you see the replacement cost box check, there has been some conflation in the past with sellers, thinking that meant that the coverage limit is adequate as well. That's not necessarily the case. Typically, what that box being checked on a declaration page indicating replacement cost, that's typically indicating how the claim will be paid. And versus them settling claims on an actual cash value basis, they're settling them on replacement cost. That is a requirement of the guide, but it is separate from whether the coverage limit is adequate. So you've got to be really careful there and make sure that you have both parts met. The claim is settled on replacement cost, but additionally, that coverage limit selected by the insured is adequate as well to essentially fully replace that property in the event of a total loss. So that would be one big key. Another area we're kind of seeing some changes in is we're seeing more and more policies, especially in high-risk wind-prone areas, where maybe a particular peril is pulled out or excluded from the policies. So you definitely want to be mindful of any notes that they provide on the insurance documentation, if it notes any type of exclusion at all. And you need to compare that to the guide. And if it is excluded and it's a required peril, then that borrower would still need to obtain the coverage. Now that can be done. They can obtain a standalone policy just for something like wind or hurricane, a particular peril that was excluded, and combine it with their primary policy to make sure that they do have adequate coverage. So that would be the second thing. Lastly, I guess I would mention actual cash value claim settlements, somewhat touching on the first topic. You want to be careful. Not all agents actually term the words how it will settle as actual cash value. They may not use those actual words. But if you're reading the policy and you see that claims will be paid off of a depreciated schedule, that's a clear indication that that is an actual cash value claims payment policy, and it's not paying claims based off the replacement cost. So just be careful there, because again, the insurance agent may not use the exact terminology red flags that you're looking for, but when you read the policy, you could understand that claims are actually being paid at actual cash value. So with that, Megan, I wanted to ask next, what are some of the proactive measures and strategies Freddie Mac is currently implementing, or at least considering at this point in time? And, in ways we could actually address some of these emerging insurance challenges that we're seeing.
Great question, Brian, and excellent recommendations on things to watch out for when looking at policies coming in. As you know, we here at Freddie Mac are constantly monitoring the insurance markets and evaluating how they impact the guide requirements. We're fortunate to have so many of you in the audience that share your observations, your concerns, and your many, many ideas for improvement. We are pleased to say that we have some forthcoming guide changes that aim to accommodate some of the challenges related to affordability and availability insurance. It's also important to recognize that there are only limited levers that we can pull, but we are thinking of creative and innovative possibilities and evaluating prudent alternatives to existing insurance requirements to help address these concerns. It will be an ongoing process, and we're very grateful for your partnership along the journey. I also want to highlight that so much of what we already do provides a strong foundation to address the risks. As the hardening insurance market only increases the importance of the role that sellers and servicers have in ensuring that borrowers have appropriate coverage. At Freddie Mac, we continue to closely monitor significant property insurers' financial risk profiles, as well as the financial profiles of state fair plans. And this continues to be particularly important because the market is becoming more complex with new capital and investment strategies like catastrophe bonds. We know that rising home premiums and coverage availability are only one of the many challenges potential buyers are facing during this exceptional time. Rising interest rates, property taxes, and broader inflation all contribute to unaffordability. But nothing is permanent, and in this business, we will see insurance markets continue to change, many for the better, while others may get worse before they get better. And that brings us to one of the last questions, which is, what does the insurance market's future look like, and where can we expect it to improve? So like all markets, they are cyclical in nature, and this is especially true in Florida. Periods of reduced availability often follow major weather events, and how quickly a state's insurance market recovers depends on the severity of the storm or disaster event, and also the regulator's response and the presence of other compounding factors like fraud and litigation abuse. So states like Florida and Louisiana are increasingly dominated by small domestic insurers whose long-term ability to pay claims is somewhat uncertain. These companies make up nearly all insolvencies. It's not the State Farms or Allstates that are going out of business. This creates somewhat of a catch-22 in that these small insurers contribute greatly to the availability in a state, and when times are good, they're able to operate well and pay traditional claims. However, a Hurricane Ian, Irma, Harvey roll through, they may not weather it as well. Ensuring that regulatory environments promote the right kind of insurers returning to markets so that we see the smoothing of this cycle. Traditionally, we know insurers will return to insurance markets as long as they are good at adjusting to risk conditions, and they will re-enter the markets if they're given the regulatory space to appropriately price that risk. But Brian, you're from Florida. What have been your experience? Do you have any home state insights for us?
I do. I have personally experienced some of the pain points that other borrowers out there might be feeling as well. So again, as Megan mentioned, I do live in Florida. It's considered a high risk state to insure in, and I have personally experienced my policy being canceled. Now, I was lucky in the fact that I did not have to immediately revert to a fair plan. I was able to find additional coverage in the private market, but it took a lot of searching. And, I employed the use of a broker And sometimes that's really your best bet. They're going to be the most knowledgeable about what carriers are still offering coverage in your particular area. But with it wasn't just as simply as changing to a new carrier. That new carrier would not write hurricane coverage, which obviously I do need here in Florida. I live in a coastal community. So I did have to obtain a standalone hurricane policy, and the premiums and the deductibles on those can be quite high. So it was, a little bit more of a financial pinch, but luckily I was able to find coverage at the end of the day. But it's not all bad news. Even just in the state of Florida here, the state legislature has taken some steps to try to improve the market conditions, improve availability. One of the major changes that they made was trying to curtail frivolous litigations against insurance carriers. It was really affecting their bottom line. At the end of the day, some of these cases truly were frivolous. And it was just a major financial expense on top of these, these large hurricanes and things that commonly pass through Florida. So when you put that strain on both sides of the company, we started to see some insolvencies. But with the change in laws, there's positive signs out there. So Megan, are you seeing anything else positive in the market? Some other signs, maybe in some other areas that are pointing towards we're starting to crawl our way back out and return to the cyclical cycle on the upside versus the downside?
There have been a lot of positive movements in the insurance market. In fact, in late September, responding to an executive order from the governor, the California Insurance Commissioner, Ricardo Lara, announced a whole series of regulatory reforms called the California Sustainable Insurance Strategy. This was pretty impactful because California has a very unique insurance market. It doesn't suffer from quite the same struggles that Louisiana and Florida do. So this regulatory reform package includes some key elements, such as expanding the state's FAIR Plan available commercial coverage to $20 million per building, and this is up from $20 million per property. This will be hugely impactful in helping some of the homeowners associations and condominium developments meet those coverage needs. The plan also includes fast tracking the introduction of new rules allowing climate catastrophe models and pricing of wildfire risks, which they're currently not able to do, and also improving rate filing procedures and timelines so that companies can submit accurate rate filings and be approved more quickly. Another big component hindering availability in California today. On another positive front, Louisiana just launched the Louisiana Fortified Homes. This program grants up to $10,000 to homeowners to upgrade their roofs to standards set by IBHS's Fortified program. This program is really neat and innovative, and it's going to help Louisiana homeowners strengthen their roof to better withstand hurricane force winds. Their first initial rollout of this will actually carve out availability for Louisiana FAIR Plan policy holders to help them get back into that private market. So all these efforts have impact, but in the short term, prices are likely to continue to rise, and they must. Insurance premiums are one of our best signaling mechanisms for the impact of climate change and conveying the consequences of decisions about where and how we build in the future. So as we continue to support sustainable and affordable home ownership, we are continuously looking for areas where we can be impactful in supporting the understanding and education of homeowners' risks about their properties. And we look forward to working with all of you and the industry jointly towards meaningful solutions. So hopefully you all found some meaningful and interesting tidbits today. Thank you for joining us. Brian, thank you.
Thanks, Megan. I thought that was a great discussion, and I just wanted to thank everyone else that joined us today. We do hope that you found the information worthwhile. Do remember, if you have any questions, of course, you can drop them in the chat, and we'll be sure to get back with you. And with that, I'll turn it back to Amani.
Thank you, Megan and Brian. We were not able to get to your questions. However, we will reach out to you following the conference. Your opinion is important. Please take a few moments to take our brief survey so that we can continue to bring you timely and relevant content. The presentation deck will be sent to you following this session. You can also log in anytime after the conference to play back this or any other session. Thank you and enjoy the rest of the conference.
Well, that's a wrap on day one of Freddie Mac Connect 2023. But don't go away just yet, because our networking lounges are still open. And you can also visit our sponsors in the exhibit hall. I'm Sonu Mittal, Head of Single Family Acquisitions, and I want to thank you for your time and attention today. It was a whirlwind of great content that I hope equipped you with practical insights that will make a positive impact on your business. My favorite session today, of course, was my fireside chat with Ravi Shankar and Jeff Markowitz. Shankar and I are optimistic about the future of our industry. We will weather some ups and downs, as always, but Freddie Mac will be here to partner with you in our joint mission to keep the mortgage market thriving for the benefit of the borrowers we serve. I would like to thank our partners, sponsors for their support of Connect, as well as our breakout session leaders, and especially today's guest speaker, Andrew Bush. I was captivated by Andrew's insights on the extraordinary pace of change happening in our economy and the world. His observations were incredibly practical to help us prepare our business with the innovation that can drive opportunities in this ever-changing landscape. As a preview for tomorrow, we've got another packed day with valuable content that you won't want to miss. We have two featured speakers for you in the morning. First is Sam Khater, Freddie Mac's chief economist, who'll provide the most timely and relevant economic insights available anywhere. Sam is always a crowd favorite. We are also lucky to have guest speaker Majora Carter with us. Majora is an urban revitalization expert who will open our eyes about different ways to transform low-status communities into thriving mixed-use local economies. Coming up next is an opportunity to network with your industry peers in the seller and servicer lounges. Our sponsors will also be available in the exhibit hall to showcase their offerings. One reminder that if you miss any of the sessions you wanted to watch, recordings will be available after the end of the conference and will be on our platform for a year. Don't wait that long to watch, though. This is relevant, strong content that can help your business today. We are happy to have this virtual format that allows us to provide you the flexibility of watching every session you want on your own time. With that, I'll leave you to enjoy your networking, and we'll see you again tomorrow at 11 a.m. for more of Freddie Mac Connect. Thank you, and have a good afternoon.